Good afternoon, and thank you for joining us on today's webinar. I'm Luis Santiago, and I'm a Senior General Manager here at Alumni Ventures Group. I'm joined by our founder and CEO, Mike Collins. He will introduce himself in short order. Before we get started, just wanted to quickly read through a disclaimer for the audience. Today, you're going to hear about the AVG Total Access Fund and our views in the associated landscape. The presentation is for informational purposes only, is not an offer to buy or sell securities, which are only made pursuant to the formal offering documents for the fund. You can find all of these documents in the secure portal. We will send out that information at the end of the presentation in a follow-up email. And you are able to review all important disclosures, all specific fund materials in the portal as you consider an investment with the Total Access Funds. As we get started here today, we've got a good agenda for you today. We're going to be talking about Total Access Fund, why we like venture, a little bit about our deals, how we source them and evaluate them, as well as take a look at what a TAF portfolio looks like at a high level. And we'll go into some examples of some of the companies that have made the TAF portfolio over the course of the last year. Like I said, I'm Luis Santiago. I'm Senior General Manager here at AVG. Throughout my career, I have been an operator in a number of different companies that have ranged everywhere from a 5-person startup to a Fortune 100 company with 65,000 global employees. I've been with AVG for a little bit over 2 years of my 15-year career. Came on board to stand up our fundraising team for our open access funds, which is inclusive of responsibility in raising the Total Access Fund, as well as our focus funds, which some of you in the audience may be very well aware of. We are currently have our focus fund that is open, that is our anti-bias fund, with a number of others that we fundraised for over the course of the year. Our base camp fund, which is our pre-seed and seed focused fund, our deep tech fund, as well as a newly formed focus fund that will be opening up in Q2, focusing on emerging VC markets. So with that, I'll turn it over to Mike. Just before Mike gets started, just want to remind everybody that everyone will be on listen-only mode for the entirety of the presentation. Please submit your questions at any point in time during the presentation through your questions module on your dashboard. And we welcome all questions. We may not be able to get to all of them just due to the constraints of time, but we will try to get through as many of your questions as possible.
Great. Thanks, Luis. As Luis mentioned, I'm the founder and CEO of Alumni Ventures. By coincidence, my very first job out of college in 1986 was with a venture capital firm. Frankly, didn't know what it was, but had an opportunity to join a great firm in Boston. And really over my career, I've been in pretty much all facets of kind of the entrepreneurial economy. Investor, board member, entrepreneur. In creating this business, it was really built on a couple of really pretty simple ideas. One, that venture capital is a really important asset class. And any sophisticated portfolio really should think very hard about having an appropriate allocation in this asset class. And at the same time, it's really a hard asset class for individuals to add to their portfolio in what I thought was kind of a smart, appropriately diversified, simple way. So I launched the very first alumni fund in 2015 with my alma mater, a network of Dartmouth alums called Green D. And since then, the business has continued to kind of grow and thrive. Next slide. So just a few minutes on AVG. We're focused on delivering smart, simple venture portfolios to accredited individual investors. We started with one alumni fund in 2015, and today we have 18 alumni funds. In addition, a handful of funds open to all accredited investors that Luis touched upon. Today we're going to talk about really kind of one of our mainstay products, our Total Access Fund, which is a portfolio that really consists of every deal that our firm does. So it's our most ETF-like product. It's a very large, diversified portfolio. A little outdated here. We're 120 employees located in the major venture hubs. Headquarters in the back office here in Southern New Hampshire. And then our investing team, which is about 50 full-time investment professionals, hundreds of years of venture capital experience, are located in San Francisco, Boston, New York, Chicago, and a new office in Austin, Texas. We have coming up on 6,000 individual investors. We have a community and a set of subscribers with all of these alumni groups that is, I think, over 600,000 people now. So the core idea behind us is we're a network powered venture capital firm. It's the power of community, is the power of network, that we can do better together than any of us can do individually as far as being a successful venture capital investor. Next slide. Again, the idea here in this slide is really just over a lot of time periods. Again, looking back over 50 years, 20 years, 10 years. Venture capital has historically been a very strong asset class. It is a part of the economy that's still inefficient. There's huge innovation. It's relatively illiquid, and as an asset class that is illiquid, it really needs to provide kind of above average returns. Again, there are great years in venture capital, like 2000 and early 2021, and then there are periods that are less good. But overall, in a sophisticated, diversified portfolio, it's an asset class that again, people should think strongly about adding. It's what large, sophisticated money managers do. If you look at the Harvard Endowment, Yale Endowment, large pension funds, insurance companies, billionaires, they invest in venture capital, and it's debatable whether that should be 2% or 5% or 15%. But it's pretty clear, again, over time, for people that have a long-term perspective, that venture capital is a really important asset class. Just anecdotally, when I was starting out in the industry in the 80s, companies would go public at a $500 million valuation, $1 billion valuation. And you could invest at an IPO or early in the company's public life as a public equity, and buy Apple Computer and hold it for 10 years, and the returns were venture-like. Much harder in 2020, 2021 to do that. There's a much more sophisticated market for later stage companies. Those of you that are watching this stuff, they'll know that the IPO market, companies are going public at a 10, 50, $100 billion valuation. And really, if your starting point is $50 billion when the VCs are exiting, that's a high bar as your entry point from a valuation perspective, and kind of ignoring kind of $0 to $50 billion and saying I'm going to start here. I think that can be very challenging. Next slide. This is something that's really important to understand about venture capital as an asset class, and a couple things to keep in mind. One, It is illiquid. I mean, these are private companies that take 3 years, 5 years, 10 years to achieve returns. And so it needs to be patient money. Our funds are 10-year funds. Unlike Netflix stock, you can't call up your broker and sell it the next day. Second point is it's a power law industry, meaning it's a hits business. The returns are really driven typically by a small number of companies within a portfolio. Our alumni funds are typically 25 or 30 investments. Our total access fund is 200 and 250 individual venture investments. Returns are driven by 5% of those investments, and you just don't know which ones they're going to be. So this is data pulled together, and along the horizontal axis is portfolio size of venture capital. Excuse me for the ambulance going by here. And on the vertical axis is the likelihood of outcome. And it really says is if you want to avoid losing money, you want a portfolio that's, at least 50 venture deals in it. And if you're looking to maximize your chances of having a 3x return, you're looking at really the bigger the better. And at least 100 companies gets you a decent shot at that kind of return. So illiquid asset class, diversify by what we do, sector, stage, geography. Our strategy is to only co-invest alongside kind of established venture capital firms, names you'd recognize. And that's kind of key to our strategy. And one of the reasons I think we've grown so quickly is it makes sense. People that do their work and research find that this is really a great option to invest in this asset class. Next slide, Luis. Yeah, these are examples of companies we co-invested in just last year. Again, depending on your familiarity with venture capital, these are top tier firms: Greylock, Sequoia, NEA, Bessemer, Benchmark, Andreessen Horowitz. Frankly, these are funds that individuals, no matter how wealthy you are, can't get into. Most of them are closed, or they have $10, $20 million minimums. We're doing deals alongside these firms. So our total access fund, which is really what we're here to talk about mostly today, is one of our funds. A pretty simple idea. We take a little piece of every investment that we do goes into this fund over the course of approximately a year. So it'll be a portfolio of 200 to 300 venture deals. It's one portfolio, it's one check, it's one K1. As I mentioned, we're co-investing alongside established venture capital firms. We are very process driven. Our investment teams do due diligence. We have investment committees. We score every deal. There's 2 or 3 levels of approval. And the Total Access Fund has the advantage of it's really open to all accredited investors. Accredited being, a definition by the SEC. Really, ironically, our system only allows this type of investing if you're financially already pretty successful. But accredited is a definition, and this is really only an offering for accredited investors, but doesn't matter where you went to school or what you do for a living. Our job is to put together a smart, simple, diversified venture capital portfolio for you. Yeah, just a little double click on the what goes into the total access portfolio. I mentioned a little bit. Those are the logos of our alumni funds. Deals are approved, say by the Northwestern Fund. The nominating committee screens it. It goes into the Total Access Fund. So it's really kind of our largest and most diversified portfolio, and as such, it's really a good fit for people who want to approach this asset class like they would an ETF or a mutual fund, and just kind of say, hey, I feel good that I've got this covered with a good, interesting portfolio. Yeah, I don't have to go into this one in too much detail, but just to give you a sense of, in the 2020 total access portfolio, there are 217 deals, really diversified by industry sector, stage, early, growth, seed, geography, obviously representing kind of where venture is done. So it's heavily still weighted toward the coasts, though an increasingly large percentage of really interesting deals are coming from a more diverse set of geographies. Yeah, I'll run through just a couple of examples. I'm not going to go through. I think we got a couple of examples of deals we did. We invested in a company called Anycart. Obviously, this trend toward kind of direct to home food accelerated during COVID. We had a very successful investment in a company called Freshly that was just bought toward the end of the year by Unilever for over $1 billion. This is another AVG portfolio company called Anycart. Again, co-invested alongside Menlo and Graycroft. Companies doing really a fantastic job. They've got their own kind of niche and twist to the food ordering and food delivery business. Early stage, but very, very promising. Next slide. BlockFi. Yeah, so this is in the crypto space. So this is a company that does lending against crypto assets. So people can use their platform, get paid yield, borrow against it. Again, it's kind of a pick and shovels play to the whole growth of crypto. Company has done very, very well. We were in the seed round. The company is absolutely crushing it. Similar to Coinbase, which is I think already filed to go public at a very healthy valuation. Again, the trend toward distributed ledger is real. Whether you think price of Bitcoin is crazy or not, doesn't matter. These distributed ledgers being adopted right and left by lots of industries, lots of financial institutions. This is one of our investments in this space. Again, really top tier syndicate of seed venture capitalists and investors. Another company, Canela Media. This is a platform focused on the Hispanic audience. Really, as everyone knows, a growth market, accelerating disposable income, really exciting traction this company is already achieving, a very obvious acquisition target. We're in, again, very early at a very reasonable valuation. Super management team. Again, 3 examples, from our portfolio of I guess a fourth Main Street, another company that's doing really interesting work, helping small businesses access, government programs and resources, tax incentives, hiring incentives. They basically do all of that for Main Street businesses and take a cut. And the company is again doing really good work and really achieving great traction. Again, just to give you a flavor of the diversity of what would be in your portfolio, every one of our TAF investors from last year are in essence owners in these companies.
Great.
Great. I'll turn it back to you, Luis. Thank you.
Hey, Mike, thanks. And so thank you to all the folks in the audience that are submitting questions. I've been responding to some of you throughout the presentation. Others, we will definitely touch on your questions during the Q&A. I just wanted to cover a couple of things here in terms of TAF. I think the natural first question is, how do we invest? And so we offer two different simple options for folks that are interested in the total access fund. There's two options. One is a single quarter, meaning that at the end of the 3-month capital deployment period, investors will have a portfolio diversified across sector, stage, geography, and lead investor of about 50 to 75 companies. As Mike said, this is a portfolio that offers up and constructs the portfolio and gives you a piece of every deal that AVG is doing. So during that 3-month period, those are all the deals that AVG is doing and involved in, and those will be put into the TAF portfolio. The other option is to invest in a full annual vintage, meaning that the capital is deployed over a 12-month period, and the portfolio again will be diversified across sector, stage, geography, and lead investor. But that will net you a portfolio of anywhere between 200 and 300 investments. And some may ask, why such the big range? And this all depends on the pacing as a strict co-investor, the pacing of lead investors and the deals that are being done in the venture industry. We see a tremendous number of deals. We do go through our disciplined process. And while it does seem like there's a lot of deals that are in this portfolio, we see upwards of 5,000 or 6,000 deals a year. The next point, and exclusive to all investors in the TAF portfolio, is the TAF Venture Club. So this is an exclusive benefit to investors that provides access to fund news, portfolio updates, venture capital educational opportunities that is in a dedicated investor club portal for all investors. And the reason why we developed this investor club portal is really in talking to investors. So many investors want to learn, because the ins and outs of the venture industry, opportunities to engage with our investment teams a lot more, opportunities to have inside discussions or more exclusive discussions with our I teams around how do we score deals. You'll be able to look at be able to score deals yourself through the syndication opportunities that are provided through the club portal. And so another added benefit is when we do have opportunities, and these are syndication opportunities where our investment teams will go out and they'll secure an allocation in a particular round. And this allocation will be much more than the allocation that they are going to be earmarked for their fund, for their particular fund. And so therefore we want to provide the opportunity for our own investors to invest alongside AVG. Now, again, this is an opt-in opportunity. There's no obligation for any investor to participate in any of our syndication deals. Through the club portal and through that syndication opportunity, the minimum to invest there is $10,000 per deal. And also, all investors will have the opportunity to participate in outside AVG, kind of outside of the club deals. So in all, for TAF investors in the club, we'll see approximately anywhere from 15 to 20 syndication deals per year. So for those looking to really learn about venture, dive into the due diligence, we provide access to our due diligence reports that are put together by our investment teams, a recording of the investment committee meeting that ultimately decides to move forward with the deal. So all syndication deals have met the threshold of our process and are approved, and will be going into an alumni fund as well, into our total access fund. And just given an opportunity, given the additional allocation in the round, to provide folks the opportunity to also invest alongside with us, and in a way double down on a particular investment that may really resonate with you. So some key terms, again, this is not an exhaustive list of our terms. For that, I would recommend that everyone go to our secure portal, read through our fund offerings and all our terms there and all our paperwork to make sure that you're familiar with our fund offerings and our structure. All funds are 10-year funds, including the Total Access Fund. It's one capital call. We reserve the equivalent of 2% management fee for the life of the fund, and reserve that up front to limit the back and forth operational complexity of capital calls throughout the life of the fund, and those are drawn down over time. And so how do folks make money? So when we have liquidity events throughout the life of the fund, all capital is returned to investors, inclusive of that management fee that's reserved up front, and the distribution and profits after that are the only things that the AVG management company will participate in, with 80% of those profits and returns going to investor and 20% going to the management company. And some of you have asked questions if these funds are available both to US and non-US based investors. And so we can provide more information on that. And just to summarize, again, there's two investment options for TAF. The quarterly investment option that provides investors with a portfolio of about 50 to 75 companies, and that capital is deployed over a 3-month period. So really gives you the quickest way to really build a diversified venture portfolio in only 90 days. And for those that are looking for a broader portfolio, a 12-month deployment period of the annual vintage flavor of the Total Access Fund. And so with that, I'll bring back Mike just to help field some of these questions. The first question, I think I alluded to it a little bit in terms of, how do I make money with the Total Access Fund and with AVG?
Yeah, again, it's as you laid out. There's one check in, and then there's many checks back. Is really to simplify it, meaning we do one capital call. Over the course of approximately a year, we'll invest it, in a couple hundred companies. If you pick the kind of the quarterly option, it'll be a 1 90-day period of that. Those companies then go on their journeys. Some will work out, some won't work out. Typically, liquidity events in a portfolio, it's a bell curve. That peaks usually in years 5, 6, and 7 is when you have most companies are bought, go public, and have a liquidity event. Again, it can vary, especially if a portfolio is large with a couple hundred companies in it. And every time there's an exit, the capital is immediately returned to the investor, either through a check or a wire, or a lot of our investors use retirement monies and accounts, so it would go back into that account, or a trust that would go back that way. But again, there's no additional fees over that 10-year period. It's kind of one check up front, and then we invest it, we manage it, and then as liquidity events happen, we'll send you an email saying, freshly got sold, we've got your check coming to you, expect it in a couple of weeks.
So Mike, another question, it seems like we've got some some alumni fund investors on the webinar. The question is, how should we think, how should that investor think about alumni funds and total access funds, and the overlap between the funds, and in the nature of how the total access, and you hit on this a little bit earlier, but just wanted to expand on that point a little bit more.
Yeah, again, I'm going to use an analogy, which is, an alumni fund. I'm a Dartmouth and Harvard alum, so I really enjoy investing alongside classmates and feel lucky to have gone to those schools and kind of enjoy paying back to future entrepreneurs. So the idea of an alumni fund is really emphasizing the kind of the community um, of those places, and the portfolios there are 20 to 30 companies. When you're talking about TAF, it's a little bit of the Dartmouth deals, the Harvard deals, the MIT deals.
Right.
So there's less community, but it's again the equivalent of kind of you get an ETF of the S&P versus a specific fund or a specific set of companies that you personally invest in. What we've tried to do at AVG is really give our investors the same options that they have with public equities. You can kind of get the asset class and fire and forget, like one does when they buy an ETF. People that want to engage a little more with the community, or they have a particular diversification that they believe in. We offer focus funds like our anti-bias fund or our deep tech fund, or we really believe that COVID is going to change and accelerate a lot of things. So we had a post-COVID fund. We have an emerging markets fund coming around the corner here. And then the ability to do individual investments that you really resonate with you and you really kind of want to make a slightly bigger investment behind, learn something. That's where syndications and the TAF club really come into play. That's the community for TAF where you can engage, you can pick, and really kind of customize your venture portfolio. So we wanted to always offer the fire and forget all the way down to, hey, I have a real strong point of view. I want to really lean in. There are things I really believe in. I really want to have BlockFi in my portfolio. We try to create those opportunities. So for the people on the call that are already in one of our other funds, first, thank you. And what I would say is, again, this is kind of broad coverage. It gets you up that curve to be sure that your portfolio is adequately sized, that you've maximized your chance to catch, that unicorn, that 50, 100, 200x. And obviously, you're going to see syndications through the TAF club that you won't see, if you're just in the Dartmouth community. So there's just more deals for you to pick if that's something that's of value to you. Good question.
Great. That is a terrific question. Another question really about the size of the portfolio and returns, Mike. How do, given that so many of these startups are promising, but so many of them will fail as many of them do, right? You mentioned it is a hits business. How do you think about returns and, specifically for TAF having, 200 to 300 investments in the portfolio?
Yeah, if you remember that slide, the kind of chart with the curves on it really kind of brings that to life for people. So again, we'll send this out to all the attendees, but that really brings it to life. And that data is pulled from kind of the entire universe of venture deals. So there's kind of alpha is taken out of it. And again, it basically says most people do not have an adequately sized venture portfolio, that the returns are so driven by capturing that 20x, 50x, 100x deal. And the data is, and uncertainty is so great that you really want a very large, very diversified portfolio to maximize your chances of making real money and frankly also minimizing the chances of losing money. People think their kind of knee-jerk reaction to venture capital is, ooh, super risky. And if you're doing 2 or 3 deals a year that happen to kind of land on your desk, yeah, that is super risky. And it's up there with like buying a lottery ticket. What we've tried to do here is make it, is to kind of give you such a large and diverse portfolio where you're co-investing alongside the smart money, that a lot of that kind of risk is managed in a much more appropriate kind of risk return way. So when you look at something like TAF, especially kind of the year flavor of TAF, you're really saying I am buying the venture capital industry 2021. And, you know, again, you're talking about 250 deals across, you know, a swath of top tier firms spread out around the country. You know, that's really what you're looking at mathematically and statistically. For us to be more than, you know, a standard deviation above or below the venture industry top quartile, is mathematically really hard. So this is what it is. And again, for people that are starting out in venture capital, or just want to be sure that they've got, you know, if I don't do any one-off deals for the next 12 months, I've got this asset class covered. I think it's a mature, prudent move, this product.
So question, just switching gears a little bit, I think going back to the syndication, I think there's an interest in that, and the venture club. Want to know how investors get notified of the opportunities. Is this something that, you know, investors need to monitor constantly on their own, or will they be, you know, pinged and let know that there's an opportunity for them to look at?
They get pinged is really the quick answer, which is, you know, venture deals that'll take place in this club. The club will be formally put together. You know, you'll be notified of that. You'll be invited in. We'll do a little demo of the platform where you can kind of get you see what the platform offers. And it's really news of previous syndications. There's some of our webinars where we're going through educational opportunities, meeting some of our portfolio companies. And then you're notified when there's a syndication. And it's a very popular part of what our clients love about us is they love participating in syndications. Their ability to listen to our investment committee call, read the due diligence, score the deal on their own, and decide, yep, I agree. I'd like to put $10,000 into this deal, or you know what, this one I'm just not comfortable with the valuation, or I don't know enough about the space, or I think, you know, direct to consumer food delivery is overhyped. That's an individual choice, right? And so we pull all of that together in a data room. There's you have to move pretty quickly. You have about a week to make your reservation, another couple of weeks to fund it. And again, no obligation to pay attention to that at all. Some people, again, as I mentioned, Luis, are fire and forget. Other people look at every syndication and do a lot of them. Some look at every syndication, do an occasional one. All are welcome.
Great. So we got some additional questions. Just follow up on that. I think there's so question number one, if I decide to do an investment in only a single quarter total access fund vintage, am I excluded from seeing syndications over the rest of the course of the year, or do I get access to those as well?
Good question. You get a 1 year view. You're invited into the total access fund club, and once you've made one investment, you're really a lifetime member, and you can go onto the platform and get updates, attend the webinars. You know, once an AVG client, you're always invited for that stuff. Investing privileges are for 1 year. So even if you're just in for 1 quarter, you know, we believe having a large diversified portfolio should be the bedrock of a venture portfolio. And so you will have that. Even if you participate in the quarter option, you're going to have, you know, at least 50 companies in a venture portfolio. And if you want to add some individual investments on top of that, again, that's your choice. It's a 1-year membership.
What are the differences between syndication opportunities for the Total Access Fund versus, say, an alumni fund?
Yeah, so the deals that are in the alumni fund are sponsored by that particular alumni team. So the Dartmouth Green D Club will see deals sponsored by the Dartmouth team, if you will. So it'll be a subset of all of the deals that we do. When you're in TAF, you're going to see deals from a variety of alumni funds. In both cases, you'll probably see between 6 and 12 deals a year. You know, again, they're not like clockwork. The venture industry doesn't work that way, but you know, a deal once a month, every couple of months is kind of the expectation. You know, very good venture capital deals are very competitive, and you know, you fight for allocation. Sometimes we can get a little more, sometimes we can't. If we can, you know, doing a syndication is an option. The other thing I'll mention too, which is sometimes there are syndications being done that are offered to a group outside of a club. We call them, you know, at-large syndication. So it may be sponsored by the Harvard fund, Yard, and we may also invite 200 to 300 of our customers to also look at that particular deal in a data room. Again, just depending on numbers and timing and variety that we like to offer. The difference is if you're seeing a deal within a club like the TAF club, the minimum is 10 grand. And if you happen to be offered a deal that's coming in through another fund that you're not part of, but just happen to be offered a deal at large, is what we call it, with a $50,000 minimum. So otherwise everything's the same, same access, same timing, but that does exist that way.
Great. Kind of working our way backwards here. So outside of syndications, you know, when sourcing a new deal, a new opportunity, how do you decide, or how is it decided which fund gets precedence? Is it the existing university fund or is it TAF?
Yeah, so we have a, you know, like a lot of things at AVG, we have written policies on all of these issues, trying to be scalable and fair. Thinking, you know, what, you know, most of us are also investors in our funds. You know, what's fair? So obviously, if a fund is sponsored by the Northwestern Fund, Purple Arch, it first goes into that fund. And sometimes that's all we can get. So it just goes into Purple Arch 4 or 5, and that's it. And sometimes there's a little more allocation, and we are able to do a syndication with the Purple Arch community. And sometimes there's even a little more syndication, in which case we can go outside the Purple Arch community to some of the other communities, some of the other funds. Again, we work really hard to be sure that there's not some kind of selection bias, either in deals that we get into and fight for allocation, or we share, you know, certain deals with certain funds get precedence. It's really not that. These are deals that are found by individually actively managed funds. It first goes to them, and then sometimes it's just, you know, hey, we've got a $5 million allocation. You know, the Northwestern Fund really can only handle $500,000 of that. That's just based on the size of their fund. Those are the opportunities where we can go out to a greater community. You know, and obviously, you know, you don't know in hindsight, you know, which of the ones work better than others, but that's just the nature of venture capital.
Yeah, in the second part of that, I think the TAF piece of it, it's not that TAF ever takes precedent. TAF is almost additional allocation to those deals, and so therefore, by being an investor in TAF, you're going to get an exposure to every new deal that we do over the course of that deployment period. So there is no competition there between the Alumni Fund, say, and our Total Access Fund. It's just something that flows through.
Yeah, and just automatically and mathematically, just our Total Access Fund, by definition, the way we structure our investments in a particular company, are in every deal. And just when we write the check, mathematically, we say, what's the pro rata of this particular TAF fund? So the number of syndications that are potentially available to a TAF investor is basically every deal, right? Mm-hmm. So there is the advantage of, if you're a green D investor, there are a lot of deals that you're not in, right? So you're involved in a certain number of deals with some sister funds, but there's a chance every time we make an investment and there's a syndication opportunity, there's an opportunity for TAF to participate. Again, to set expectations, it's not you're going to see a deal every week. You're going to see a deal a month, 6 weeks, something like that.
Another question, I think this as we work backwards here, kind of what are the funds total invested that AVG has raised and invested over the course of the years? No, AUM isn't the proper term since we do invest the funds deployed immediately.
We've raised $650 million. I haven't checked lately, frankly, but it's order of magnitude. It's up in that range. We'll raise around $300 million just in 2021 is kind of our current projection. We raised 240, just under 240 in 2020. The business has grown 20 to 60% every year since we've began. But yeah, we'll have raised $1 billion, in the next year, 18 months.
Yeah. In terms of TAF, and I might take this question, how much is currently invested in the TAF fund? I think over the course, it's really a product that we really structured and kind of revamped really last year. And since then, I think we're north of 25 million in terms of how much we've been able to raise and invest in the TAF fund. And so, it's a product not only suitable for individual investors, but also have had a lot of interest from wealth advisors and through their clients. So it's been something that has been able to really address a lot of the needs of both institutions or wealth advisors and their clients, but also the individual investors like many of you on the call here today. In terms of accredited investors and what that means, I know maybe some of you have not heard that term. It is not a process. It is not a certification. You don't need to go anywhere and get notarized to be accredited. It's quite simply a definition set by the SEC at its simplest, and we will send you information on that. But at its simplest, it's as an individual having compensation of over $200,000 over the last 2 years with a reasonable expectation to earn that in the coming year, or as a couple, the same criteria but just 300,000, or a net worth of $1 million excluding your primary residence. And just recently, the SEC has expanded the rule to also include those licensed with a Series 7 or 62 or 82 in terms of being accredited. And we can send those details to you. So that was a slight expansion in terms of who they believe are sophisticated investors, and just by nature of the illiquidity of the fund in terms of it is locked in for 10 years and then you get this many checks back, as Mike mentioned. It is really reserved for those that the SEC deems as sophisticated investors. And like I said, we'll provide that information to you in our follow-up. Guess if we don't have any additional questions, these have all been great in terms of the great questions asked by the audience. I just want to thank everybody I want to thank you, Mike, for spending time with us, and want to be mindful of everybody's time. I'm sure everybody is kind of zoomed out and Zoom fatigued. And so with that, I just want to wish everybody a great afternoon. Stay safe and be well out there. Take
Yeah,
care.
stay safe, everybody. Thanks for joining. Thanks, Luis.